If you are thinking about succession planning, then you're probably thinking about selling or transitioning ownership of your business, which means you are probably thinking about the price you can or should get for it. That's what this webinar is about, price. More specifically, I will give you some things you can and should do if you want to improve your chances of successfully negotiating price. My name is Phil Thompson. I'm a business lawyer practicing with Thompson Diamond in Richmond Hill. Buying and selling businesses, including helping owner-managers with succession planning, is the biggest part of my practice. This webinar series is being brought to you by the York South Simcoe Training and Adjustment Board. The board is a non-profit entity funded by Employment Ontario with a mandate to help maintain and facilitate the growth of the local labour market in York Region and South Simcoe. This series of webinars will focus on a team approach to planning a transition, covering such areas as preparing a transition plan, steps for determining the net worth of your business, and steps for moving the business from you, the present owner, to another owner while creating goodwill. The 4 webinars on our website exemplify the team approach. They are financial planning, determining the present owner's financial stability for the future in preparation for succession of the business to another, business valuation, determining the net worth of your business, business coaching, moving the business from the present owner, you, to another, thereby separating the business from the person and creating goodwill. And this one, legal. My webinar will focus on negotiating a price. After all, you will not be able to sell your business if you cannot negotiate a price both you and your buyer are happy with. We have learned that our success rate in closing deals for our clients is over 90% after the buyer and seller can agree on price. Before getting too specific on price, however, I want to give you some overall guiding principles to think about which affect your whole deal, including your price negotiation. The first is that selling your business is a process, not an event. This is especially true if you are selling your business as part of a succession plan. Because it's a process, it takes time and planning to do it successfully, as you will have heard or will hear about in the webinar on financial planning. In fact, it can take years to set up and get accomplished properly. Ideally, you will start the planning process several years before you plan to transition out of the business. If that milestone is in the very near future, then you better start planning right now. Tax planning should be done far in advance, as your tax plan may have to mature for 2 years or more to get the best possible plan for you as a seller. It is also important to remember that a good transaction of this kind is as relationship-based as your customer, supplier, or employee relationships. Your deal will go much better, and you should even get a better price if you and your buyer are committed to having a good relationship with each other. If you want to do a transaction with each other, keep in mind as well that good business relationships are not win-lose in nature. Building good business relationships is covered as well in the webinar on business coaching. Finally, there is more to a good deal than price. This is a very important point to keep in mind, and one that I will come back to later in this webinar. Based on our experience, the number one impediment to selling a business is the seller's price expectation. This means that the number one impediment to you selling your business is your own price expectation. The good news is that you control your expectations. This is something you can and should work on in advance. Plan to manage your expectations. You have to remember that no one will value your business more than you do. After all, price negotiation is all about risk assessment, and no one understands the risks of your business better than you do. And no one is as comfortable managing those risks as you are. One thing you can do is learn how businesses like yours are valued from a buyer's perspective. While you might only sell 1 or 2 businesses in your career, there are business valuation professionals who will handle hundreds of transactions in their careers, and some of those professionals are very knowledgeable about your industry. In the webinar on business valuation, you'll be hearing about various ways to value a business, including asset-based valuations, earning-based valuations, and some rules of thumb for various industries. This presentation on price assumes future earnings are the most important thing your buyer is looking for, and that you are selling your business as a going concern. While that is not always the case, it is the most common scenario in our experience. On the other hand, we have built lots of useful ideas into this webinar, even if future earnings are not that important to your buyer, as one way or another, you and your buyer still have to agree on a price for your business. In that regard, one important thing you must do if you are going to successfully negotiate price is to set realistic goals. You need to do this before you get into any serious discussions about selling your business. Keep in mind that there is no single perfect price for your business. There is just a range of reasonable prices that depend on a lot of factors, most of them connected to each buyer's unique situation. Your goal is to end up as high in the range as possible, but it is simply not realistic to expect that you will and should be able to obtain the highest possible price. You should also remember that there is more to a good deal than price. I'm not saying that price is not important. It is usually the most important factor in a deal. However, there are a lot of other things to a good deal, including tax structure, payment terms, security, transition terms, protection of your employees, and lots of other things. Finally, please remember that the best deal is rarely a win-lose situation. If you approach selling your business, especially the price for your business, with the idea that you will pick someone else's pocket and squeeze every last thing out of them, plus more, then you are risking a deal that falls apart before it closes, or becomes a big problem after it does. If you want the best deal you can make, then you should recognize that the price part of the deal must have some win-win in it for both you and your buyer. If you are going to maximize the price you get for your business, then you have to be prepared to manage the buyer's risk perception. The more risk the buyer believes it is assuming, the less it will pay for your business. Or to put it another way, your buyer is purchasing a business opportunity. The greater the perceived opportunity, the more it will pay for your business. The number one way a buyer manages its risk of falling short on opportunity is in the purchase price. You have to remember that the buyer always has other things it can do with its money. These include investing in other things, like stocks, bonds, mortgages, etc., as well as buying businesses other than yours or investing more money in its own business. A good buyer will compare what you want for your business to other things it can do with the money. You should have some idea what those things are and price your business accordingly. You also have to find out why your buyer wants to purchase your business. They must see an opportunity to make money or they would not do it. They must see an opportunity to make more money than they would make if they used the purchase funds to do something else. You must be prepared to minimize their risk perception in this context and maximize their perception for an upside. Think of yourself as selling an opportunity to make money, not just a business. No two businesses are the same, so there are bound to be things that are unique to your business. If you are selling an ongoing business, things you can be looking at include the age of your business, its historical trends, its stability, that you have corporate goodwill to sell rather than personal goodwill, strong relationships with customers, suppliers, and employees, proprietary technology, an important bundle of assets, a well-financed balance sheet, strong market positions, or the strength of your industry overall. The key point to remember is that you have to be prepared to manage the buyer's risk perception if you want to get the best possible price. And you have to be realistic in doing so. Making excessive or foolish claims can only hurt you. Ultimately, someone buys a business for the money they can make from it after they take it over. They buy a business for the returns they can make from it. What this means is that the price you can get for your business depends heavily on two things: the returns you have to sell and the rate of return your buyer feels they have to get to be comfortable buying your business. As a formula, it works out like this: price equals returns divided by rate of return. To maximize price, you need to make returns as big as you can and the rate of return as low as you can. Let's start with returns. The bigger the returns, the higher the price. So you need to have a good understanding of what returns your business has generated and will generate in the future. And be prepared to present those returns as persuasively as possible. You may need help from your accountant on this. A buyer will want to compare these returns to other things it can do with its money, which means adjusting your profits for taxes, cost of borrowing, and capital reinvestment. This results in returns that can be compared to other things like stocks, bonds, mortgages, and different kinds of businesses. It is often called EBITDA, earnings before interest, taxes, depreciation, and amortization. For privately owned companies, because of the things owner-managers can do to minimize taxes, it also means adjusting for all the money the owner-manager takes out of the company in various ways. If you want to maximize your price, you need to understand this and be able to present your business profits and returns from this perspective. The other part of the formula is rate of return, also called return on investment. The lower the rate of return the buyer is comfortable with, the higher the price to you. In order to lower that rate of return expectation, you need to make the buyer feel very comfortable with the risk it is taking on, especially when compared to other things a buyer can do with its money. This is where the idea of being competitive with your price comes back into play. We know that stock markets historically do 10% per year in returns over the long run. These are large companies run by some of the smartest people on the planet. Yes, publicly traded stocks are risky, but still a lot less risky than privately owned businesses. We also can see at any time what bonds, GICs, T-bills, term deposits, and mortgages offer in returns. They offer lower returns, but lower risks as well. In our experience, returns on privately owned businesses range from 18% to 200%. Where you fall in that range depends on a lot of factors, but mostly tied to goodwill, risk, and likelihood of future profits. You need to understand this and be prepared to present your business in this light. Keep in mind that rate of return includes both return of your buyer's capital and return on your buyer's capital. Ultimately, a buyer wants to know how quickly they will get their money back, and then what they will make on top of getting their money back. Be prepared to speak their language and have a competitive and realistic presentation. If you are going to use all this to successfully negotiate price, there are several things I want you to keep in mind. It does not matter how you and the buyer get to the same price, as long as you get there. You and your buyer can have serious disagreements on issues related to calculating the price for your business, but it should not make any difference if you can get to the same price anyway. Do not be surprised if formulas and arithmetic will get you close to agreement, but not quite all the way. When that happens, do not get stuck on the mathematics. Do not let formulas and rules of thumb have the final say. Also, remember that structure has a big impact on price. These factors include tax structure and tax planning. After all, it is not the gross price that really matters. What really matters is what's left to you after taxes. The total deal value can include things other than purchase price, like surplus cash you can take out of the company before closing, non-competition payments, debts assumed, consulting fees, and post-closing compensation for providing transition assistance. All these things have different tax consequences. Do not get so focused on the price that you forget to stand back and look at the deal as a whole and see how it looks from there. Remember that supply and demand have a big impact on price. If you have something unique or special to sell, something that is hard to find elsewhere or build from scratch, or something that a lot of people, or at least some very key people, want to have or keep someone else from having, then your price will be positively affected. However, if you are selling a business that not many people want, or at least the right people do not want, or if you are selling the kind of business that is easily acquired elsewhere, or even built from scratch, then your price will be negatively affected. If you want to improve your chances of successfully negotiating price, then you should retain some good professional advisors as part of your transition planning and use them wisely. Get them engaged at the very beginning and keep them engaged as you go along. Use them to help you set your expectations and goals, and also use them if you and the buyer can get close on price but cannot quite get there on your own. They should have ideas on how you can bridge that gap, which can include tax planning, price adjustment clauses, holdbacks, financing options, etc. Find advisors who have done this a lot, challenge them, and listen to them. Finally, please remember that there is more to a good deal than price, especially when succession planning. Finding the right buyer to take over your business, one who will respect what you have accomplished and take good care of your customers, suppliers, and employees, and being able to hand the business over to them at the right time with the least hassles are all just as important to a successful plan as the price you sell your business for. I recommend that you take a few minutes to watch the rest of the webinars and to do the small quiz accompanying them on our website. You will gain more insight into some of the other aspects of succession planning, whether it's financial planning, business valuation, or business coaching.